Okay, everybody, this is our last session of the day, and I'm ready for the party. Although I don't think we're going to need our sunglasses because the sun will be setting, not blasting us at the moment. But we'll see you out on the beach. But not yet, because now we have our very special State of Shareholder Activism panel. Just as a reminder, the 50th anniversary reception is going to follow this. It's out on the Windsor lawn, which is the big lawn between us and the beach. And remember to bring a sweater or something because it's going to be cold. Not for me, for you. I have mine. I'm ready. Okay. I'm delighted to introduce to you the chair of this session, who you, I'm sure, already know. Brian Braheny is the head of Skadden's SEC reporting and compliance practice. His practice focuses on M&A, corporate governance, general corporate and securities matters, and shareholder activism. Prior to joining Skadden, Brian held several positions in the Division of Corporation Finance, including serving as chief of the Office of Mergers and Acquisitions and as deputy director of legal and regulatory policy. He has a great panel who he will introduce to you. So, Brian, take it away.
Excellent. Thank you, Dixie. Good to be back. Good to be with you on our last panel of the day. We hope to keep it interesting and exciting for you. The title of our panel is What You Need to Know About the State of Shareholder Activism. And as you probably know, activism is a hot topic. And so what we've come up with today are 5 sort of principles that we think are important for you to understand as you think about this issue. And as Dixie pointed out, we have an all-star cast on this panel. Starting on the far left, Leo Strine, who's of counsel at Wachtell Lipton, and as many of you know, have been a longtime jurist in Delaware. When we were emailing the plans for today, Leo's response was, this all looks good, but let's keep it interesting and exciting for the group. Of course, my response was, Leo, that's why we've asked you to join us, to keep it interesting and exciting. So welcome back, Leo.
Hi. Well, thank you. And if you notice, because I'm up here, they shut the shades because to avoid the reflective thing off of my head. They're trying anything to serve the audience. Right,
exactly. Next to Leo is Gabby Wolf, who's a director at Innisfree Incorporated. She advises companies and investors on all aspects of shareholder engagement, focused on proxy contest, shareholder activism, hostile and friendly acquisitions, contested shareholder meetings, and all such ESG. Prior to joining Innisfree, Gabby was an attorney in the M&A group at Skadden, and I had the pleasure of working with her when she was there, so welcome, Gabby. Next to Gabby is Avi Mehrotra. Hope I got that right. He's the co-head of Mergers and Acquisitions in the Americas Group and the global head of Goldman's Activism and Shareholder Advisory and Takeover Defense practices. He was previously the global head of Financial Institutions M&A at Goldman. He's been at Goldman for many years and an excellent addition to the panel for all the work that he handles. So thanks, Avi. And last but not least, to my immediate left, I'm proud to be able to welcome Michelle Anderson to the panel as a private citizen. You probably heard earlier today that Eric mentioned that Ted Yu was recently promoted to Associate Director in the Division of Corporation Finance. He took over the role that Michelle vacated, and prior to that, Ted was the M&A chief. So, you know, clearly the power position at the SEC and Corpfin is the M&A chief. Two of them are the most recent ones sitting next to each other. So welcome, Michelle. She's now a partner at Latham in their Washington, D.C. office, and she's going to give us all the inside scoop of the things the SEC did when she was there. She's no longer has any requirements to hold back. So thanks, Michelle.
You don't have to give a disclaimer either.
No more disclaimer. Yeah. So as I mentioned, we have 5 things we want to talk about. First up is, you know, number one, activism campaigns are at an historical high. As I mentioned earlier, it's a hot topic. We keep hearing lots of conversations about it. So I thought I'd start maybe by asking Avi to comment on activism M&A activity in 2022, you know, campaign levels, the impact of private capital, the pressure that companies are getting to accelerate their, you know, shareholder returns. We'll start there. I think everybody believes that these campaigns are at a historical high, but maybe, Avi, if you don't mind, you can take us through it, and we have some slides.
Yeah, absolutely. So, you know, you can follow along on the slides, but I'll try to just keep this a little bit, you know, high level. So, first, if you just start with M&A overall, we had a year in 2022 where the M&A volumes were down globally about 35%. So that doesn't sound, terribly exciting or positive, but it was down off of an absolute record level. So it went from almost $6 trillion down to $3.8 trillion. So when you sort of contextualize that, at $3.8 trillion, the 2022 M&A year was the 5th best M&A year since the financial crisis. So that's not too bad, right? The other way we think about it is imagine that 2021 was the bad data point. That was kind of like the spike, discard that data. In 2022, we're at levels that were actually higher than even 2020. So that's not a bad story. The other way we think about this is we always look at M&A volumes against the equity market cap that they come against. So if you take the entire global aggregated equity market cap, take the M&A volume divided, you get a ratio. Historically, that long-term average has been about 7%. When we've pierced that average, it has undoubtedly led to a bubble. And that happened a couple of times, once in 2006, 2007, and then that was followed by the 2008, 2009 dislocation. It also happened in 98, 99, and 2000, and the data shows that. We pierced it well above 7%, and then that led to sort of the downturn in 2001 going forward. But at these levels, even at the $3.8 trillion that we saw last year, it's at about 5%. So that makes us feel pretty good in the context of sort of a 20-year look. The other way we think about this is that private equity has increasingly become a very, very big piece of the M&A market. Historically, it used to be about 25% of the M&A market. Now it's in excess of a third. It's approaching 35%, may even go higher than that. And we basically prosecuted all of these M&A volumes last year in the second half with virtually no private equity activity. So if we can hit $3.8 trillion, be below trend, do it without private equity, have it be the 5th best M&A year in our history, that feels pretty good. And so as we look at 2023, we're cautiously optimistic that we're headed towards sort of at least a better level than we were in 22. So now you take the activism overlay to this, and I'll relate these two in a minute. So activism was at the highest levels we've seen in 5 years, right? So the next highest activism peak was in 2018. 2022 was sort of higher than that. But I think some more interesting statistics are that when you look at the S&P 500 now, 1 out of 4 companies in the S&P 500 has an activist in it. If you look at the FTSE 100, 1 out of 3 companies in the FTSE 100 have an activist in it. When you look at all of the data that I just cited, this is all just the visible activity. And you should think about this as sort of the tip of the iceberg that you can see above the waterline. All of us are working on situations far in excess of the visible activity when we think about the boardrooms we're in and the client conversations we're having. As Brian alluded to, a lot of these conversations are private. There's an enormous amount of private engagement behind the scenes in activism. And then, one statistic that I zero in on, which is that, large cap activism is a little bit different than, small cap activism. And when you look at the number of campaigns over $10 billion in size, directed at companies over $10 billion in size, in 2022, we saw 36 of those, right? The next highest point was 19, and you had to go back to 2018 to see that. So on the large cap space, we're up almost 90%. That's an enormous amount of activity. And I would also add another interesting fact, which is that all of this proliferation of activity, 2/3 of this is being prosecuted by what we call first-time or occasional activists. And we'll talk about universal proxy and the implications that may have. So you sort of tie all this together. Activism is at this enormous high, overall campaigns as well as large cap campaigns. There are lots of new players doing it.
No, can I just ask, because it's the afternoon and we're all, do Nelson Peltz and Bill Ackman have like a first-time activist like dinner when they do that? Like
I don't know if they're training people or not.
Okay, I just whether there's
a
kind of an acculturation that occurs.
Yes, there may be, but I would say the following. So we can talk about this a little bit later. So Bill Ackman has said he's no longer an activist. Okay, he's publicly proclaimed that, and if you hold him to his word, he hasn't really launched a public campaign since probably the Chipotle, kind of.
Now I was going to think, an actual California taco thing is now run by Chipotle here, and I it's a little
absolutely. So we can talk more about that later. But what I was going to say is you put these two things together, right? Now, if M&A is down, if activism is really important to M&A, right? If you look at activism campaigns, almost 30%, 40%, depending on the year, have an M&A component to it. So what are the activists doing? And we'll talk about this. What are they doing in the absence of M&A or in an M&A market that's slowed down a little bit. So as we get into the conversation, you'll see that they're shifting their tactics a bit because they can't necessarily rely on M&A, even though we believe, from our seats that we're sitting in, that M&A should recover and should recover nicely from where we were in 2023.
Excellent. Well, thank you for that. So next up, what are these campaigns, what are they demanding? What are they focused on? What were they focused on? What do we expect they might be focused on this year? Maybe I'll ask Gabby to start here and give us sort of the benefit of her expertise and experience, and then Avi, maybe you jump in kind of after that as well. So Gabby.
Sure, thank you. So we are seeing, as Avi said, traditional activism focused on M&A. The trend now is for pure play companies, so a lot of sell a business that doesn't make sense, that's not synergistic with the rest of the businesses that you own. We're also seeing a bunch of activism, what I like to call bumpitrage, where an activist in a target stock decide that they're not getting enough money. And often they're supported by merger arbitrageurs, and these are folks who come into the stock after the announcement of a merger when they smell blood in the water and think that there might be more money in the buyer's pocket. They pounce, and there can be a lot of pressure on the buyer to pay a little bit more, which is sometimes why I like to advise clients that if you're in a hostile situation, reserve 10% in your pocket so that you have it for later. But there also have been big campaigns. Now we've seen a lot of stock deals. In some cases, if they're over 20% of your stock is being issued in this deal, then the buyer also needs a shareholder vote. And we're seeing a lot of activism on those in the buyer's shareholder base before a vote, right? The shareholders don't like how much the buyer is paying. They think they're overpaying. They don't think that the businesses have any synergies, et cetera, et cetera. And that is a real problem because when we see M&A activism on the target side, there's always the safety valve where you can flip it to a tender and avoid ISS opining on it. And a tender also has the effect of not allowing shareholders to really consolidate around a certain meeting date, and it's harder for collective action with a tender offer. But with a buyer side activist,
keep that in the room, though, right, Gabby?
Oh yes, keep it in the room. With an activist on the buyer side, don't tell them our tactics.
Don't tell ISS.
There is no safety valve. There's no tender offer safety valve. It has to be a vote under the proxy rules. Or under, I should say, the Securities Exchange rules. So that's a kind of interesting situation. On our last slide, two before this, I think, we had said that, traditional return of capital might be hot. I'm going to disagree with that and be a little edgy. I think that traditional return of capital activism via stock buyback or dividends may be less popular given the volatile market and potential recession that we find ourselves in. Companies, I think, are more likely to conserve cash and maybe reevaluate appropriate capitalization levels. A similar thing happened post-2008, the financial crisis then. Companies kept more cash on their balance sheets to preserve credit ratings and also in case, for liquidity reasons, in case one of their fundamental businesses needed some money. And then during the bull market that followed that 2008 crash, we saw activists then come back and ask companies to reduce their cash reserves on their balance sheets. So I think we'll probably see a similar trend now. I mean, the last thing I'll mention very quickly that has been talked about a lot at a lot of the panels here is poor ESG performance or a lack of a coherent ESG strategy that it will make you vulnerable to activism. As they mentioned on, I think, 2 panels before this, it has to have there has to be a direct financial, the activist has to demonstrate that it hits the company's bottom line, that there's financial material impacts of this ESG problem on the board. But previously, ESG concerns were kind of just window dressing that an activist would feature in the campaigns to bring index funds on their side. Now, and they weren't really central, now we're starting to see ESG as a major driver of activism. in itself, and that's in large part due to the substantial influence of index funds and pension funds. They own about 20 to 30% of all large and mega cap companies, and being that they are permanent capital, they cannot vote with their feet. They can't just sell a stock when they are not happy with what the company is doing. They have a very long-term perspective, and so ESG arguments, the long-term nature of them, really resonate with these shareholders.
Yeah, just a couple of things I would add to that. In a world where M&A has slowed down, if you're an activist, you can't put a company into play, you can't easily have somebody divest a division because private equity may not be ready to buy that division. What do you do, right? And so I think the activists have, for the moment, started to shift into operational activism, right? And this started to happen in the fourth quarter of last year. There's some notable campaigns. If you think about public campaigns, if you think about Starboard attacking Salesforce, and now there are a whole bunch of other activists on top of that. Starboard simultaneously had attacked Splunk, which was a large software company. But all of these attacks were really about profitability, margins, and getting back to basics. And I think it's very much tied to where the broader investment community is, leaving the activists aside. And I'll come back to that in a minute because I think it picks up on Gabby's point about whether we're going to see return of capital or not. You also saw Altimeter, which is not an activist, send a very public letter to Meta, right? This letter was all about improving operations. And in all of these campaigns, and then there was a fourth one, I should say, TCI came after Alphabet, but in all four of these campaigns, it wasn't just the activists focusing on operations, or in the case of Altimeter, not activists focusing on operations. The broader shareholder community in all four of these cases came out and supported what the criticism was. Now, while this started in tech, our full expectation is that that was the lowest hanging fruit, and it's going to expand from there. And so this operational activism, in the absence of a more reliable and robust M&A market, I think is a trend we're going to see certainly for the next couple of quarters. The other thing I think that's important is, so let's think about return of capital and whether this is going to be a theme or not, right? So in one of the slides we have, if you look at share repurchase activity in 2021, it got close to $1 trillion. That was the highest that we've ever seen in terms of corporate share repurchases. You go to 2022, it got over $1 trillion, at $1.1 trillion. So we're entering 2023 with two back-to-back record years of absolutely high share repurchases. Now, the case to be made for why return of capital is going to be important goes something like this, and this is beyond the activist, which is that you're expecting, as a normal asset manager, a flat S&P 500 today, right? You're expecting we may close the year at about 4,000. We open the year at about 4,000. So when the expected return is zero, every incremental 100 basis points matters a lot. So if companies that give you a dividend of 1 or 2%, that's 100, 200 basis points. Somebody who dials up share repurchases and gives you an incremental return of another 200 or 300 basis points, that matters a lot. So all of a sudden, between the dividend and some incremental share repurchase, you could have a situation where you're earning 2, 3, 4, 5% against a market that's supposed to be flat. And we're looking at corporate balance sheets right now because, in this low interest rate environment that we've had for the better part of a decade, most large cap corporates have used that time to term out their debt and to refinance debt, right? And so they're sitting on pretty healthy positions. If they wanted to, they could dial up, I should say, the share repurchases and the return of capital. So if you're an activist, I think this is going to be in your toolkit. It may not be the most exciting thing to lead with, as Gabby's saying, but at the same time, against a flat return environment, if it gives you a couple of 100 basis points of return, and increasingly these activist positions are being built up with leverage and options, et cetera, which we can talk about, I think it becomes pretty interesting to certain activists, certainly for large cap companies. And so the new demands as we think about them are, profitability, operations in the absence of an M&A market that's robust, and then focusing on return to capital because it's a sure, safe way of generating incremental return.
So Gabby, you mentioned sort of ESG as an area of focus. What is it? Is it the E, the S, the G? What have people been focused on? What do we expect? We clearly are focused in the area of disclosure, expecting rules of the SEC. But is there something activists are zeroing in?
So we have seen the most successful ESG campaigns. I mean, everyone has talked about this ad nauseum, but I actually worked on it, so I think I'm due. Engine number one's campaign against Exxon was the first, ESG campaign focused on environmental sustainability, where ESG was core to the activism campaign as opposed to kind of window dressing, where the central argument was unrelated to ESG. That was a particular case. They had not listened to their shareholders for years. Their shareholders were very frustrated. There were stories about how Vanguard was asking to meet with an independent director and management refused. They had ignored shareholder proposals for a long time, even those ones that passed or ones that got in the 40% of the shares voted. And that, most importantly, the activist was able to demonstrate the financial materiality, the fact that Exxon wasn't preparing for a transition and for the potential that there might be lower consumer demand for their products, and showing that that was a real problem, that was a business risk and not just an ESG risk. I could see, there have yet to be an activist campaign focused on a human capital management or a social issue, but I could see an activist make an issue of, poor management of an issuer's supply chain, of the cost of workforce or the rate of employee turnover, especially given now that a lot of issuers are disclosing their EEO-1 data, so there's a lot more transparency around these things. So you can actually compare peers, how many employees they have, how many part-time, full-time, et cetera, et cetera. So that is a potential where I could see, a connection being made between the ESG issue and the company's bottom line, but we'll see. Last year we did see some pullback from the index funds, at least with respect to shareholder proposals, as they were getting more prescriptive, which we heard 2 panels ago, so stay tuned.
So Carl Icahn had a fairly high-profile campaign against McDonald's in their sort of food processing, which wasn't successful. Are you finding, and this could be for maybe Avi and Gabby, are you finding certain shareholders that you think are interested in these matters, or you mentioned Vanguard in the matter you were dealing with, that they were interested? Are there certain large investors that you're worried about or should be worried about that might be more open to supporting a campaign that's based on ESG?
I can start. I'd say I'd worry about the investors, but I'd also worry about the target and what the performance profile is. I think Icahn picked a couple of targets in Kroger and McDonald's that were inconvenient for him. Those companies were not doing poorly. They were actually holding their own against a tough environment. And I think the investors were not willing to sort of see him on his issue, and it was unclear whether board change needed to be made at those companies. I think the bigger risk is if you pick a target that's underperforming with an issue like that, and investors then conflate the underperformance, which was sort of irritating them in a different way, and then you sort of put this ESG issue on the table, the conflation of those then could lead to a conclusion, and ISS could be complicit in this, which is that we need to make some change, right? And it may not be on the ESG issue per se, but you sort of put those things together, you get a friendly association, I think, if you're sitting in the corporate boardroom. And I would focus as much on that. I would keep an eye on the investors. I do think that they're trying to reevaluate how they're being judged. We heard this earlier in the day. They're in the spotlight. We can see some hearings with Congress and some of these large index funds. We'll see where that goes. But they're in an increasingly uncomfortable position. And so I think that they may be dialing back. But the thing I would watch for is just if you pick the wrong target or you pick the right target, depending on your point of view, that's not performing, and you put one of these issues on, then what happens?
Gotcha. So let me ask you, there was some profile, but maybe not across everyone's desk, where some of the large investors are allowing, some of the index funds and others are allowing directed voting, which I think started at BlackRock, and I've heard may be expanded beyond that. Is that having an impact? Are there shareholders that are interested in taking them up?
I mean, I think no is the big answer. Look, we haven't seen it yet, so it's just been piloted. I think last year BlackRock had already piloted, Vanguard will be piloting it, and State Street this year. Most of the people who would have wanted to take back their vote from a BlackRock, Vanguard, or State Street in this kind of structure have already done it and already had private agreements, right? They were like pension funds or mutual funds that had private agreements with BlackRock, State Street, or Vanguard, where they voted the stock on their own as it is already. So I think this is really just responding to the political backlash that the big 3 index funds have gotten from...
Yeah, why don't we, any of you in the room, how many of you are index fund investors? Raise your hands high, be proud, it's late afternoon. How many of you want to vote every proxy? How many of you want that in your inbox? Right, this is totally optical nonsense that involves shifting responsibility in some convenient way, and frankly, if it happens, it will just up the power of activists because, like the broker, people used to buy. Remember the idea of buying a company's stock because you liked it, and supporting management, and then we took away the broker non-vote, and all it does is basically shift the power to the activists because you take the long vote that supports the company's policies and you basically reduce it.
Yeah. And by the way, I think, Leo, you said this, far more plainly than I could, just given your style. But the way I would think about this is there's going to be some arbitrage here as well, which is that the activists are going to sit there and say exactly what Leo just said, which is that this is going to have no fragmentation of the vote. I can still carry 2 index funds. I can win, right? And the corporate boardroom, I think the arbitrage is going to be a little bit different. They're going to be much more cautious, and they're going to say, you know what, I could have counted on BlackRock and Vanguard together. That was going to be 20%. Now I've got to assume fragmentation. That 20% is 15%, 12%, 10%. And so I'm going to take a much more conservative mindset, and oh my God, I can't win the proxy vote, right? And I think it's going to tip this in the direction that Leo just mentioned in a really perverse way, which is even if the activists are only mildly correct, they're going to over-index on it, and it's going to make boardrooms be even more cautious. And again, we're early in this. We'll see how it develops. But we're not looking at this as a quote-unquote positive development, just like I'd put universal proxy in the same category.
I was just going to say that's exactly like universal proxy. It just puts a thumb on the scale on the side of the activist, just a little bit more leverage.
And don't forget, there's draft legislation too. It's called the Index Act that will seek to require that of the large investment asset managers. So never say never.
No, but by the way, that could be, if it was balanced by, to be honest, a federal policy scaring the heck out of investment managers in the 1980s and making them vote on things that they didn't care about changed the whole inertia of corporate governance. The only reason ISS exists, it was not because anybody wanted it. Nothing against my friends at ISS, but the only reason they exist is because of the regulatory mandate that made institutional investors vote on things they don't care about. Institutional investors vote on mergers. If there's a real proxy contest, they'll vote. But now the votes are there's always enough votes to make change, and there's always an episode, whether it's a say on pay, there's always a moment where you can have a momentary thing that upsets long-term direction of a company. And you wonder what we're doing for our society. It's interesting, but I said this when the little engine that could won, and I was glad for that. But what would be the case at the next few annual meetings? And Avi and Gabby, there's all kinds of cool cash coming in from a dysfunction. There's a long-term energy transformation opportunity for those companies. And what's happening? Is the engine one, is that money being put in to accelerate the transition?
Unclear.
Is it unclear? Or is it kind of actually pretty clear that the returns to investors of the excess cash are being accelerated? Right? I thought buybacks and other things are happening. I'm just saying this is a journey. And the thing we all know about sustaining something over time, right? It's easy to destroy an institution. It's very difficult to sustain it.
Yeah.
And I'm saying I think the engine one, if you look at the energy space right now, we look at the prices and because of the war and everything, if we look at what the argument was from ESG activists a couple years ago, it's that these businesses really need to accelerate the transformation of their energy production from carbon and methane based to something new. You now have all this free capital to accelerate that, and I'm just wondering where the market demand is, Avi and Gabby, for that.
Yeah,
Now, I'm just saying, this is real stuff for us as a nation and society, and there's a gamesmanship aspect of it, but it is, it is pretty striking. And when everybody, so what I was going to say is asterisk engine one, because what does that victory mean if actually this opportunity is not actually seized on in a way that really is transformational? If it's simply an opportunity to do more buybacks and dividends, where are we going to be when the cycle turns,
Yeah,
right?
absolutely. Look, another way of thinking about what happened at Exxon, and we didn't work on this one, but Exxon started before the attack, 9 board members, right? And we can be critical about what Exxon was doing or not doing, from a board standpoint, from an IR standpoint, et cetera. But when the dust settled 6 months later, there were 12 board members, not 9, and 5 of those board members were new. And so another way of asking yourself is that was that much change justified based on the path that that company was on, right? And we've created an environment where that kind of rapid change can be accelerated and catalyzed by single actors.
No, and I think you can also make an argument that for those who just said, to be honest, we're an energy company, the world still demands this thing. There's a little bit of a thing, but to be honest, continuing to be a carbon-based energy company is really profitable. I don't know. You kind of read the news. It looks like it's pretty darn good to be a carbon-based energy company right now in these same markets. And the same investors who were the majority still hold the majority of American people's capital. And, these things are not year to year, but that's how the game that we're talking about is actually done.
I'm just going to say you sound eerily like some of these anti-ESG activists.
I'm not anti-ESG, but what I mean is I don't think that you can ignore. I don't like the labeling, and I don't like the trivialization of science. The fact that as a nation, we can't talk about things like science anymore and their effects. But to ignore the fact that there's been a delegitimization of elites, that people do play games, labeling games, that hurts the center. And I think, we can't play pretend. And in this area, a lot of important things. Remember, I have nothing against Mr. Icahn, but what was notable about his campaign against McDonald's? He was the majority owner of one of the largest pork processors in the nation. He owned very little of McDonald's or Kroger. His daughter asked him to get into it. So that was a kind of difficult, a little bit piquant of position, perhaps, to capture, the moral high ground. And as people on the right or left, we're entitled to disagree. As people see these things and they see the governance of corporations as playthings, it actually gives, frankly, a microphone to some of the extremists, because they've got an open opportunity to kind of pick on these things. And I just think it's naive to deny that, or the fact that corporations get caught in looking a bit hypocritical. And then when you're staring down the Klieg lights of the activist campaign, that's a difficult situation to be in.
So Leo, maybe we could pick up there. So campaigns are historical high. The demands have expanded. So what should folks in this room, advising boards, what should they be focused on? What should they be concerned about? It continues to be, when you get these surveys of board members, one of the sort of top 3 or 4 areas of focus that board members are concerned about. What steps should companies be taking to prepare for these? Should they be concerned about their own liability?
Liability?
For the board members, or response to these, mention this.
No, I don't think it's a liability issue. I think it's a question of fiduciary responsibility and understanding what it is. My view is, if you're thinking about addressing activism when it happens to you, you're not just late. You're way late, right? You're like when Zach Prescott tried to down the ball last year, remember, in the playoffs? By the way, news to you, Jalen Hurts can't play in the Super Bowl. No, that's not true. I'm trying to see if you're awake. Consistent. My number one thing, if you ask me sort of broadly, Brian, what you do to prepare as a director, is it really starts fundamentally every year you're there. You have to say, what is our business plan? Are we running this like a business that responsibly makes money for our investors? They are going to look at your capital allocation plan, and they're going to look at where it is. And if you're not running a business plan right, you're going to be vulnerable. If you remember, GM did all these complicated corporate governance things back in the day, and they thought they had done everything that CalPERS and anybody in the world wanted, and then they had a down year, and they had a turnover. You can't escape in these markets. The institutional investor pressure for you to deliver has never abated. These other things remain plays for value or branding. The other thing is risk management structures, attending to your key issues. How can you hurt a consumer? If you're a pharma company, are you putting all your risk management in audit? Why are people good at finance, good at pharmaceutical or airplane risk? When you have one of these things that you can't explain, that gives the activists a window. Board composition. Are you a former congressman, and are you looking at somebody who's a former entertainer, and that this is an actual serious board? And if you were running a business, it doesn't look like that people in the room have the expertise that would be relevant. Are you looking at, I hate the term board refreshment. Does that mean there's like, it's time for gin and tonics? But the term is, you know, how are our independent directors, have they been resolutely independent for 13 years with the same management team? Where are you in management succession? You know, most studies show that as a leader of an organization, after sort of 5 to 8 years, unless you're extraordinary, like someone like Jamie Dimon, who is extraordinary, or like Sir Alex Ferguson or Bill Belichick, most people hit a high mark. Have you turned it over, right? Communications with your stockholders. It's not wait till the activism and meet your stockholders, right? For most of you, if you represent as a general counsel or company, most people are at least in the Russell 3000. If you're in the S&P 500, the reality is that you're going to have a core group of index investors who are pretty essential to you. They're not always easy to find. The smaller your market cap, the more vulnerable you are, and the more difficult it is to get the attention of them. But you do want to be reaching out to your mainstream investors. You do have to recognize that ISS has clout. You don't want to be driven by corporate governance policies that are sort of check the box, but you should really be asking yourself, and this may seem strange for somebody who's at Wachtell Lipton, but you should be asking yourself is why are we doing anything out of the ordinary unless there's a justification? Things like pay policies and other things, you know, I wouldn't try to lead the class in those things. I would be careful about defenses. I mean, the reality is if you don't have a classified board, and most of you won't, or you have a supermajority of independent directors, which you do, your directors are not going to want to play Alamo and they're Davy Crockett. They're not. Because they're on other boards, right, Avi and Gabby? They're on other boards, and they know that ISS and the other investors take in mind. So you're not going to win in defenses. We'll talk about universal proxy and why it's become maybe a perverse, you know, chance to meet the Delaware Court of Chancery. But what I'm saying is actually on defenses, your best defense is be fundamentally a smart director. Run your company in a way that makes money the right way. Look at your capital allocation. Make sure that your board and management look like they should. Talk to your investors, and you're probably still, there's going to be a recession, there's going to be a down year. But if you do those things, I think, Avi and Gabby, that's what gives you the high ground to try to come out, and we'll talk about what winning means, but Brian, to address an activist campaign from the high ground, to have the credibility with the mainstream investors to do it. And it may be that you make an accommodation, because here's another thing. Don't be stupid. Don't be arrogant. Don't burn down the village to save it. That happened in my town. You ever heard of DuPont? It left the city of Wilmington. And it left the city of Wilmington before Nelson Peltz. And it broke down over putting Nelson Peltz on the board. And the Pyrrhic victory of beating Nelson Peltz within a year was a different management team. 3,000 jobs were cut, reverse arbitrage, tax arbitrage, and there was a settlement, and it could have involved Nelson Peltz being on the board. That was the only thing. They were going to put somebody on the board, but he couldn't be on the board. These things, you have a duty not to break something because you wish to keep it. And I think what I'm saying is if you prepare for these things, and you get targeted by some of the better activists, you can probably take it into some place that's livable. And if you're going to have the showdown, my last thing is if you're going to have the showdown, don't put targets on yourself and on the company that you can't when you don't make them, worse things happen to your stakeholders and your communities of operation than would have if you had settled. That's also a responsibility, and we've seen that a lot. You put a marker, you start doing stretch plans, right? Why was this not your business plan? Remember, you're also delegitimizing yourself, Brian. If you've been telling the market this is your plan, and then all of a sudden, magically, you can have a 15% higher return on investment. Well, why were you not doing that before? You know, and so running your business day to day, testing your business plan, making sure that you really are doing what you can, and not acting episodically or impulsively when an activist campaign comes around, and not having to because you have credibility. That would be my main suggestion.
Can I, as a follow-up, interested in your views, the response to the decision in Marchand, were you surprised by it? I mean, there's so much ink
On
panels.
what? Yeah, so on the Marchand decision?
Yeah.
Yeah, my friend and mentor, Bill Allen, I'll tell you a funny story. Used to be you could see behind you, and there was a great Delaware lawyer named Gil Sparks, wonderful Delaware lawyer and professor named Larry Hammermesh, and Bill Allen, I believe, in our other panel. And somebody asked Bill, and he got distracted. He said, I don't know about that. I just know that I'm looking back, and there may not have ever been a panel in the history of SRI with less hair. But if you think of what Chancellor Allen did, right? He encouraged people to monitor, but he basically said, you know, you got a duty of good faith. And the way I analogize, if any of you know of like family law concept, there's a concept of neglect, right? And it's not negligence. Neglect is you let your child play in the road every day, and you watch from your window while your child who's 5 years old plays in the road. And you never send your child to school, right? That's not negligence. That's not like you turned your head one day, Brian. That's neglect. And what Bill Allen really said is you have a duty to try. What I mean is you've got a responsibility to try to exercise your duty of care, and you're supposed to put in place a monitoring system. In the Marchand case, they make one product, ice cream. People died. There were yellow flags, there were red flags. There was not a board committee that was focused on safety. There was not a reporting relationship to the board. There was no evidence of efforts. And remember, this is the other thing about books and records, a little tip. You can help yourself big time in Caremark cases by having process because you produce books and records. And when the books and records, you get credit for trying. It doesn't mean you have to succeed, but if you try, if there's evidence that a committee looked at it, they tried. When you produce 2,000 pages of records and there's no there, so I think we thought, honestly, I'm not going to speak for anyone, I think we thought that there had to be something to Caremark, and when you have no process for monitoring, if we didn't actually held that at least stated a claim, I would also say in the wake of that, there were criminal convictions of the company. The CEO is still under felony charges. But yeah, I think we said there's a bottom to this. I think you've seen a lot of companies with good processes get cases dismissed. But here's the thing, if you have a Caremark claim against you, you've already lost. And it plays into what Avi and Gabby have said, Brian, is you usually have already paid regulatory fines. You've already hurt your credibility with a consumer or somebody. And that opens the door to activism. And so the Caremark, actually having the complaint not dismissed in the Caremark case is usually just the confirmation of that there's already been a failure. And the activists do look for these things, and they look for vulnerabilities. They should actually be looking for vulnerabilities in your risk management structure. That's what investors should be doing. And so that's my answer on that, Brian. I still think it's the second safest thing in the world to be a public company independent director. The first safest is what Avi is, investment banker.
Maybe I could just, while we're on the subject, what about the McDonald's decision? We talked about ESG being an area of focus, and that was handed down recently.
Is this the new dollar menu?
Yeah. Of course.
I mean, I think, look, I think it's relatively unsurprising that officers have a duty in this area. I think there's still a lot to be developed. The Delaware Supreme Court hasn't talked about it, and I'm not sure. I think Bill Allen addressed his liability standard to boards of directors, and I think if you were GCs, this is an interesting one to think about in terms of your leverage with your managers, because I think many of you would have thought that it was a negligence-based standard for the officers. See, there's also 23.1, which didn't come into play. So it's a little bit odd, but it's a good lesson. Can I just say, if you are general counsel, many of the wisest things you will do in life is working with litigation counsel to not bring certain motions and to remember that what's the standard in a motion to dismiss? The court has to accept all the allegations as true and every reasonable inference against you. And some of the lessons, Brian, I think are, it's hard to say to somebody who's been attacked reputationally, but to say, do we want to defend this? Don't we want to actually defend it on the merits and at a different time than to actually make a motion? And I know that that's hard, and I know we're not the litigation panel, but working with your litigation counsel, explaining calmly, people are emotional, they've been accused of something that we do want to vindicate you, we want to do this right, but do you really want us to go into court where we have to accept everything that's said about you as true? And not only that, we have to give every reasonable inference against you. Is this where the ground on which you want to fight? I mean, because that's sort of what General Custer did. Nobody knows who General Custer is, right? Google it. You're in a military town.
All right, so let's pivot and get to our next point, which is the SEC rule changes are having an impact. We know that universal ballot is on the books and has already been used in a couple of contests, and also the SEC has proposed some changes to 13D and G. So I thought I'd ask our most recent insider to kind of take us through those, and hopefully the rest of us will weigh in particular about what the lessons we've already learned from the contest that had universal ballot. So Michelle,
Sure,
please.
yeah. I'll do a high-level summary of the universal proxy rule, what it requires, what it doesn't do, because I think there's some misconceptions out there, and then kind of just talk about where we're at with it today so far and the experiences thus far since the rules have gone into effect. Since September 1st of this past year, the new proxy rules have been effective for any contested annual meetings. The new rules require the use of a universal proxy in all non-exempt contested elections, except those involving registered investment companies and BDCs. They're out of it. A universal proxy is a card that contains all of the duly nominated nominees, regardless of which side is nominating them in a contest. The purpose of the rule was to allow a shareholder to vote by proxy to choose their preferred mix of nominees, regardless of who nominated them. I still feel a little bit like I need to defend the SEC action just a little bit, only because I know where this is going to go in terms of advantaging activists and things like that. Truly, though, I will tell you, the Commission's intent was always meant to be neutral. It truly was. And it was really more focused on the fact that institutional investors could figure out a way to split their vote, show up at the meeting, have the legal proxy, and be able to pick and choose among the various nominees, regardless of the slate. And retail was not allowed to do that. That was the driving factor behind universal proxy, and so now we are here. Whereas before, retail was stuck with just choosing that binary choice, either company nominees or dissident nominees. You could only use one card. Now they can mix and match at their choosing. Real quickly, a couple of the key requirements, just to summarize. The final rules revise the bona fide nominee rule, which requires nominees to consent to be named in any side's proxy card. It eliminates the old short slate rule, which I was really glad for because it really made no sense. It established various notice and filing deadlines for dissidents and companies, and the point of that was really just to facilitate the preparation and dissemination of proxy statements. You had to figure out what point people knew who was going to be on cards so that they could go ahead and print and mail. One of the key requirements, and it was a change from what the Commission first proposed back in 2016, is that it requires a minimum solicitation threshold by the dissident. They have to deliver their own proxy card and their own proxy statement to at least 67% of the shareholders representing, 67% of the voting power represented by shares entitled to vote. Now, yes, there's a way to do that cheaply. You could do it by notice and access, just put your notice up on the internet. Up until now, no proxy contestant ever used notice and access. You know why? You can't win. You have to mail, you have to give the physical papers out to people in order to actually get the votes back. So we can talk about that a little bit more, I think, when we get into the dynamics. And then, of course, prescribed formatting for the card. It has to be neutral. You can't have your nominees in really big font and the other side's nominees in really teeny print. Nominees should be listed alphabetically, but they can be divided between company nominees and the other side's nominees and indicate who you might be opposing from which respective side. Things that the rule does not do that, again, I think there are misconceptions about. One, it does not create a federal right to nominate. That is a matter of state law and a company's governing instruments. And again, as we've talked about, the nominee still has to be duly nominated under a company's governing instruments in order to then appear on a universal proxy. Second, universal proxy is not proxy access. They are two different things, and people all the time are referring to it as the new proxy access rule. It's not. Proxy access was the rule that was rescinded by the SEC after the district court defeated it in the Business Roundtable decision. That was where a proponent could just name a nominee, have them included on the company's card. The company would mail. Proponent wouldn't have to do anything. It just got to free ride off of the company's proxy solicitation efforts, have its own supporting statement in the company's card, and do nothing else. Universal proxy is very different in that a dissident still has to deliver its own proxy card. It has to deliver its own proxy statement, albeit perhaps more cheaply than a full-blown mailing. It has to provide all the required disclosures, go through the comment process, file on EDGAR. It has to comply with that 67% minimum solicitation threshold. And it also has to include the company's nominees on its card. And the company, all it has to do is include the dissident's nominees on its card. It does not have to include a supporting statement about those people. It just has to kick you over to the filing that's on EDGAR for more information about those nominees. So again, quite different. And then one final, I think, misconception out there is that somehow people think the 60-day notice requirement that dissidents have to give to companies to say that they're going to nominate individuals at the next annual meeting is not intended to at all trump a company's advance notice bylaw provision. Most of those provisions, it's a range of 90 to 120-day notice provisions. And as long as it's something more than 60, that's fine. So just wanted to clear up a few of those conceptions.
Can I pick up a little bit on the Chief Justice's excellent speech at lunch, because I think this is a point you've made, and I think it's really important, which is the SEC has tried to be careful here to respect what's within the domain of state law and what's
Very much
this.
so.
But you heard, Caremark, you may have heard of the case called Blasius, also decided by Chancellor Allen, or Schnell versus Chris-Craft, right? Delaware law has historically, right, because precisely, think about the business judgment rule and the relationship between that and ballot box integrity, right? The whole point is we give deference to people who, because they're elected and they have legitimacy, which means you want to have fair elections. Whether you like universal proxy or not, the point of universal proxy is to try to move towards a ballot. There'll be product sellers or people will tell you, like, let's use this as a chance. So instead of 90-day, nomination, let's go back 180 days or other things. Delaware law is going to look at restrictions on ballot access in a skeptical way, and it's going to look for it to be reasonable. And so what I would say is be very careful that if you're putting in a bylaw to implement universal proxy, that's in fact what it is. If you wish to tighten up your rules because it's sort of advantages against activism. Be careful about that. Not saying don't do it, but don't try to make it a sell about universal proxy. And be very careful about this. If you're going to put rules on other people's nominees, you better make sure you're doing it with your own management slate, right? People look, that goose and gander rule is frankly, it plays in courts of equity. So I'm just saying that there's an awful lot like this. They're not saying, Michelle, right, that there's not issues with universal proxy. But we shouldn't act like it's transformational. And if you're going to do something that's really motivated because you think it gives you the leg up in an activist campaign, remember the legal standard that's going to apply. Think about how it's going to look, and think about whether it's reasonable. And by the way, think about whether you're going to upset your mainstream investors because you're drafting something in a way that may make BlackRock or Vanguard or State Street or Fidelity think that if they just take an ordinary meeting or whatever, they're caught up in something that you've done, because that may actually give the activist a leg up, right? Remember, overplaying your defensive hand is something that these folks, right, Avi and Gabby, use as a leverage point with your mainstream investors. Yep.
I've actually seen that some of my clients this year, corporate gadfly McRitchie sent in response to some of these really onerous bylaws that were enacted in response to universal proxy, the universal proxy card. These companies adopted really onerous bylaws that Chancellor Stein was alluding to, and now McRitchie is requesting in a 14A proposal that companies allow shareholders to vote on all such bylaw changes. Normally, most companies under their charter and bylaws are allowed to, boards are allowed to change the bylaws themselves. But because, pigs get fat, hogs get slaughtered, we might be seeing a change in that as, governance gadflies are saying, well, we can't trust you anymore. Look what these boards have put into their bylaws without any shareholder vote. So.
I want to ask Avi to weigh in here just in a second, but before I get there, Michelle, can I ask you, on this point, two questions. Number one, do companies have to do anything in response to this? And number two, there's a bunch of hoops that you just explained for this new rule, as often is the case with SEC rules. Who's policing this? Is this a company? Is the staff going to police it? Maybe you can address two of those. And it gets to Gabby's point, because you'll hear in a second some companies have taken steps, but do they have to? Should they?
There are some minimal new disclosure requirements and you might have heard that earlier on a panel, that the annual meeting proxy statement has to do things like explain when the notice is required and when you summarize the advance notice provision, if the universal proxy requirements are different from your notice provision, you'll have to summarize those too. So we've actually, at our firm, we've been strongly encouraging companies to take a thoughtful look at their advance notice provisions. First of all, make sure you have one. Every one of our clients has one, so that's just got to be bottom line. But look at them again. You can incorporate the 14A19 requirements into your advance notice provisions so that, one, it helps streamline your disclosure in your proxy statement, but it works as a self-help mechanism, right? Because if a dissident fails to do what it's supposed to do under 14A9, it risks violating that proxy rule as well as possibly a 14A9 material misstatement, anti-fraud type of violation. But are you going to wait and sit around for the SEC to go ahead and enforcement to pursue that? Are you going to litigate that? Or would you rather have a self-help provision in your bylaw that allows you to invalidate that nomination to the extent that the dissident hasn't complied with the universal proxy requirements? So we've definitely been recommending that companies do that, and we have a whole task force that's keeping track of that for our clients, and in fact are able to sort of track how many have done that. So far in the S&P 500, 27% of those companies have revised their advance notice bylaws to incorporate the universal proxy requirements. 15% of the Russell 3000. There's some other, I think, less aggressive type of changes that we're seeing many companies make and that we're recommending, including claiming the white card. It's always been my favorite issue. It was when I was chief of M&A too. Everyone fights over the color of the card. Everybody wants the white one because that's what people are used to seeing and used to voting. And so we're seeing companies ensure that they will retain the white card through their bylaws, prohibiting the ability to include placeholder nominees, seat warmers, and then you do the little bait switch at the end, and the dissident puts in a substitute at the last minute, or the practice of over-nominating, putting forth more than there are seats up for election. Again, sort of putting off that decision as to who you really want to nominate. So there's, I think, some really good practices that companies can do now.
The staff put out some CDIs on this topic, and one of them dealt with if the company determines that somebody who's looking to use or rely on universal ballot was not successful, either because the company believed that they didn't satisfy the SEC rules, or if they've adopted one of these advanced bylaws, that the CDI kind of explains the disclosures that would be required. So in some ways, it seems to me that those CDIs are staff guidance, not commission guidance, but rarely are those things put out without getting some view that the staff is sort of, in some ways, indicating that companies likely will be policing that themselves. So, so I mean, maybe our statement on the slide here is SEC rules are having an impact. Are they?
Yeah, so look, the way I would think about this is, I know we've talked a lot about bylaws and the impact that that's going to have. To me, this is a sort of passing moment. Companies will make some modifications to their bylaws. I think more sophisticated companies will reach the conclusion that Leo and Gabby talked about, which is that by doing something too aggressive, it could backfire. But I think we're going to get through that phase, and that's going to be sort of an episodic piece of it. I don't think it's going to have a lasting impact. I think the lasting impact is going to be something more fundamental, and I don't know that this was what the SEC intended, but one of the practical impacts of this is going to be that it is easier now to target individual directors. You heard this earlier in the day, and every board has a weakest director. And now it's changed the conversation in the boardroom as to how to present directors, think about your weakest link. So that is a very practical impact of the rule change.
And the proxy advisory firm said exactly that too. That is how they're going to evaluate universal proxy
That's
contests.
exactly right. So that to me is a very substantial
and I think that's going to complicate an issue that already exists for boards, which is the increasingly no thankless job of being on the compensation committee.
Yes. There's some directors that may be more vulnerable than others. So that's
and that because they're already the subject to bearing the heat depending on the say on pay stuff. And so, I think that's, and that creates issues for recruitment and other kinds of, because it's not, I think you're right about your weakest director, but I think, Avi, you don't necessarily mean your weakest, it could be that it's your strongest director.
Who's most vulnerable.
But they've actually, they're most vulnerable in terms of the atmospherics of the vote.
Yeah, no, better
Or
said.
they don't present well, they're not ready for the prime time, they're older, white, or male.
Well, I know what I said. I think what we all said before, looking down the road at your board, every time you sit in a board meeting or you're a GC and you've got a potted plant or somebody who really doesn't belong on your board anymore, I think what we're saying is deal with yourself in a graceful way, have a nice party, take them to the fancy restaurant, but if you don't get them off the board, then just, people are going to notice.
Yeah, I think ISS in a guidance note a couple months ago, they said age, tenure, and lack of engagement. Those are your negatives. Positives are your very specific and unique direct characteristics, expertise, background, and diversity of background of your skill set, et cetera.
Yeah. So so that's kind of one very practical aspect. The second, in terms of the impact, is that whether we like it or not, it is going to create an environment where less credentialized activists, less resourced activists are going to go after larger companies, right? And so if Nelson Peltz wants to attack P&G, and that's going to cost a $30, $40, $50 million fight to run, this rule change does not impact what he's going to do. It doesn't impact what Elliot's going to do. It doesn't impact what any of these very large resource activists are going to do. But it does, by reducing the barriers to entry and reducing cost, does sort of raise the specter of less credentialized players who may have had more of a sort of hesitation to taking on a large target, they're going to feel more emboldened, right? And now the dynamic of this is even if you don't take the proxy fight to the distance, you get a lot of notoriety by taking on a big name company. You get a lot of visibility. It may actually impact the AUM that you can grow going forward. Those sorts of very real world impacts, I think, are going to be things we have to live with. And we had made sort of a very simple grid. We said, look, large companies, small companies, credentialized activists, non-credentialized activists, and the intersection of that grid of large companies, less credentialized activists, that's going to be the box where we see the most change from this rule. And again, may not have been the intent of the rule, but I think that's going to be that impact and the single director targeting impact.
I think on that point, we have not yet seen that sort of materialize for our clients yet.
It's early.
It's still early days, but we are starting to see those, single issue or these new special interest activists starting to convert their shares into record form because many advance notice bylaws require that in order to nominate. And also they're starting to reach out to director search firms and things like that. So yeah, I guess time will tell.
Yeah.
So Michelle, before we move on to our last topic, I want to just touch on the 13D proposals and wonder if maybe you could crystal ball. Will we see final rules this year? If so, when? Will there be changes? Obviously not giving us any inside baseball, just your personal.
Sure, and I don't have any inside baseball anymore, so this is just truly my speculation. The beneficial ownership rules that were proposed almost a year ago are now listed on the Commission's unified agenda for adoption. The goal is by April of this year, so I don't know if they'll make that or not, but it does signal to me that it's still very actively being worked on. It would be one of the biggest modernizations of the beneficial ownership requirements in decades. A lot of very heavy-hitting letters, comment letters to the comment file, and as Chief Justice Strine knows, the issues they're the same. The debate is very much the same. The tables, it's such an interesting issue because it always turns the tables on who is advocating for what, who wants more disclosure. It's not your usual people who are asking. And it really has created interesting alliances too. And so, the comment letters reflected that, and there were, some really hefty letters from major activist firms, from companies, of course, institutional investors, investment advisors, investor groups. There's a portion of the proposal that addressed just shortening the filing periods for 13Ds, 13Gs, their amendments. The key one, of course, being shortening the initial 13D period from 10 days to 5 days. It will help identify an activist who is seeking to increase their position in the company, but then making them make those intentions public without an ability to further accumulate shares in private. The 5 business day reduction did get quite a bit of support in the comment letters, and so
yeah, I mean, it's just, but our all hope is lost as a nation.
Okay.
If that gets traction, because it's entirely ridiculous, and we are behind Brazil, we are behind all of the EU. You can accumulate through all things. Frankly, what would help the SEC is if the Dodd-Frank poison pill, the one line was struck, not the other findings, but the cash-settled derivatives, because the swap proposal, to be honest, was probably a little bit overbroad because of that gap, and that galvanized some weird things. But this 5 business days, I mean, one of the whole debates we have, I used to think about when you released opinions. If you release information during the trading day, then the mainstream investors might actually act on it. If you actually release information after the markets close, are people not trading on that information? No, it's simply not the people who represent ordinary people. And so the idea that you need 5 business days, that you have to get to Washington, I mean, it's a kind of ludicrous and silly thing. But I do want to make a practical point about the relationship between this universal proxy thing, Sean, and everything. If the SEC, I think what the SEC did was pretty balanced. It's not what everybody would want. It actually doesn't bring us into best practice internationally, but at least brings us somewhat closer to the end of the 20th century, is if the SEC does this, Michelle, the reason for companies to do overreaching bylaws as a response to universal proxy really goes down. And what we say is, like, some of these bylaws look like you're writing a shadow 13D at precisely the time when the SEC is actually taking a hold of this issue and trying to bring it about. And it's not like the investors won't recognize that discordance, and it's not like plaintiffs' lawyers won't either. But I just think it's sort of funny because these folks can accumulate an awful lot. And I believe, Avi, am I wrong, Gabby, that they can accumulate stuff on non-business days?
Yeah, depending on the market they're trading in.
But do they promise, for example, not to do business? Like, could that be the thing? Which is that they swear under oath that a business day for them is the only day on which they will trade. And that if they take 5 business days, anything that is not considered a business day, if they trade and acquire any kind of security during it, that would be a violation of federal civil and criminal law. Have I solved the problem? It's an abstention doctrine, an honor, but an honor on your oath. Because I would say, if you're an activist fund and you're trading, then it is a business day for you. So, I mean, that's just basic. I mean, again, can we be mature about corporate governance? These people work for these companies. Communities depend on them. And we should have rules of market disclosure, and ordinary investors are affected by these things. All we're saying is some fair disclosure that looks a little bit like all the other market economies where activism is booming.
So with our last few minutes, maybe I can ask Avi and then Gabby to talk a little bit about, what they're seeing in settlements. The point we made was proxy fights can be risky. Not necessarily the companies always lose, because they certainly do not. But sometimes that and you heard this earlier when Leo mentioned the point about DuPont, sort of like what companies end up doing in order to try to win, and the box they may put themselves in can be risky. So maybe Avi first, you, and then Gabby.
Yeah, so look, I think certainly in large cap boardrooms, for the most part, I think people understand this quite well. There are a lot of settlements, not a lot of large cap situations go to a proxy fight. There have been some over the years, but there are few and far between. There's 1 or 2 every couple of years. The way we think about this is that there is a very high bar if you're going to take something to a proxy fight. So let's start with the very basics. Running a proxy fight is incredibly exhausting. So back in the days when we did physical roadshows and flew around the world, think about doing that not for 1 or 2 weeks, but for 3 months, right? Think about doing that not just with your management team, but with directors. And as Gabby said, some directors are built for the road and some directors are not, right? So that's kind of threshold number 1, just what is involved in running the proxy fight. The second is, if you're going to run a proxy fight, it's all consuming, it's very distracting. Who is going to run the company when you're running the proxy fight, and who is going to run the proxy fight? Now, we've seen different strategies on this where certain clients of ours will delegate. Very large companies can delegate. They've got the management depth to do this for someone to run the proxy fight, and the core management team, the C-suite, continues to run the company. We've seen very large companies do the exact opposite. They take the entire CEO, CFO, GC suite offline. They're running the proxy fight. Somebody else is running the company, right? And so there are 2 different ways to go, but that is in and of itself a distinction and a decision you've got to make, whether you have the capacity to do that. The third is, what do you need to do to win, right? And I think Leo spoke to this earlier. More than likely, you have to put new targets out there. You've got to give investors something new that is a counterpoint to what the activist is saying. That could be margin targets, it could be profitability targets, it could be growth targets, and then you're held to those targets because they're publicly out there. So that's kind of the third level, which is a high bar. The fourth consideration is that you can't just win a proxy fight 55-45. You've got to go in with your calculations feeling confident that you can win 70-30, 80-20, and here's why. If the index funds are owning 25 to 30%, in some cases 35% of the company, one index fund can be 10%. If your base case going in is that we can win, but our margin of victory is 55-45, one index fund surprises you, that actually turns a winning situation into a loss situation. Very, very risky. So if you're going to win a proxy fight, you've got to win the way GM won against Einhorn, 80-20. You've got to win the way we won against Ackman, at ADP, 75-25. If you go into this and you have a stalemate like P&G, where we're counting the votes and subsequently figuring out, like, was it 49.99 to 50.01, that effectively, even though P&G concedes that they never conceded that they lost, they put pelts on the board, right? Because they felt that the next time around, BlackRock was not going to side with them. So that's kind of the fourth consideration. And then I would say the final consideration is you've got to be very honest about what your path to victory is. Do you need 2 of the 3 index funds to win? Most large cap companies do. Can you sustainably do that? Can you win with only 1, right, if you get surprised? And I think it's really important to figure out where retail plays in this. One of the operative places in Exxon was Exxon had a very high retail base. Retail is, conventional wisdom is very much supporter of managements. But no matter how good a job you do, half of retail doesn't show up. So what happens when you have a 40% slug that's retail? Half of that's not going to show up. The denominator in the votes is no longer out of 100, right. It's out of 80. If the index funds own 30, 35, they've got to get from 35 to 41. So you've got to think about this very, very carefully as to what your path of victory is. It's got to be clear. You've got to have some margin in it, for something to go wrong. And even in some of the greatest proxy fight victories that we've had, we've won by large margins, but we've still been surprised by index funds and we've still been surprised by investors. And so I think the reason that you see so many settlements is that large cap companies in particular go through this calculation, they go through these 5 steps, and they say, as like Leo had said earlier, if there's something that I can live with that's realistic, shouldn't I just settle for that versus going through everything I just described?
Well, I'm going to ask you all to find Gabby at the cocktail party, because she definitely had something more to say, but we unfortunately are out of time. Thank you to the awesome panel. We hope you enjoyed today's program. Back tomorrow for the last and the third day. The 50th anniversary reception starts right now behind us on the lawn, the Windsor lawn. We'll see you soon. Thank you.